lot of your own modeling. You have your own targets. What's the big takeaway, your big takeaway from tech earnings so far?
Well, look, across the board, they've been unmitigatingly amazing. Now, obviously, we're dealing with a comp from last year's quarter here that is relatively easy, to beat. So you're going to see some artificially high growth rates there. But what we're more looking at here are two things: how the stocks are performing in the pre-earnings period relative to the consensus trends in that period, and then how the stocks are performing the post-earnings period. And what we're finding here this quarter is that the alpha models that we provide to our quant clients that look at the changes in consensus in that pre-earnings period and the delta between the Wall Street and the Estimize consensus have done incredibly well, while the post-earnings models, which just look at that surprise, have not done that well. And what that tells us basically is that the market is looking at these huge surprises as relatively transitory in terms of the fundamentals of the business. They're not looking at these as massive read-through to the future of the business. But what we're also seeing is that the out-quarter estimates on Estimize from the buy side are getting really stretched from the Wall Street numbers here at this point, to the point where we haven't seen this in a very long time. So what we believe is that it's not necessarily transitory, that a lot of this increased revenue growth is going to stick. And if it does, these stocks are still, in a sense, undervalued.
Interesting. I want to hone in on the ad market, because obviously we saw Facebook and Google blow it out of the water. Then Twitter shares plunging 15%. We just heard from the CFO, Ned Siegel there. What's happening?
Look, I mean, the economy's on fire. Something like Google, there's a joke out there that's not so much of a joke, that Google does its best to kind of keep its take rate, kind of within a small band each quarter to make sure it doesn't really upset regulators, and they weren't even able to come close to doing that this quarter because there's just so much money flowing in. And e-commerce has just done so well that they weren't even able to kind of keep that in check, lower than they wanted. I don't think that's going to change here, considering the directionality that we're seeing in the expectations. A similar thing happened to Facebook. And I think we're going to see it across the board when the rest of these e-commerce companies report, because, the read-through from Google is just amazing.
So do you think that the momentum that these companies are seeing now is going to stick? I mean, what happens after the economy is open for a few months? Then what?
Right. So looking at some of the other sectors, what we're seeing is the expectations for consumer spending over the summer are going to slightly shift. But the real question is, in the long term, does the e-commerce versus kind of in-person retail mix, how much does that revert? And that's kind of been the question all pandemic, trying to figure that out. I think that's playing out in some respect right now with Peloton. The stock doesn't look very good. They report in a couple of days. There's a lot of, nervousness around that one. Personally, I think that one could round trip. Because that is a name where you could see massive flow just back into experiences and away from hiding in your home. But on the other hand, when we look at Shopify and we look at all of the other names that are just directly e-commerce driven and away from in-person retail, we don't see it giving too much of that back. And so I don't think this is transitory. I think, this is here to stay, and these names deserve the high multiples that they're getting because the growth rates are going to be huge.
I want to transition to Bitcoin. We've got Bitcoin back almost to 57,000, but when you look at Coinbase losing some of its momentum in trading since the direct listing, what's happening there?
So there are the cryptocurrency ecosystem is moving so incredibly quickly right now relative to, let's say, a year ago. A lot of projects that were being built over the last couple of years have come online now. And especially in the DeFi space, what we're seeing is platforms like Uniswap eat into the margins, eat into the market share of Coinbase. And you also have Binance, which is the 1,000-pound gorilla. as well. And I think when people look at Coinbase in the public markets, they tend to see AOL. They tend to see something that was an incredible platform to onboard people to a new ecosystem. But is it really going to be the thing going forward? Or are we in an AOL and Netscape versus kind of Google and Facebook environment? And that's what I tend to believe. And so as we see a lot of these other projects, go ahead.
Hang on, you think Coinbase is the next AOL?
I have a strong feeling that Coinbase could be the next AOL here. That Coinbase basically has a choice. They can end up like AOL or they can end up like Facebook. And the reason Facebook is Facebook today is because they took their stock and their balance sheet and they bought everything that they possibly could that they thought was a threat. And they did an incredible job at that. You can put Google in that category as well to some respect. Coinbase is going to have to do the same thing because there's so much innovation coming down the pike, and their transactional model is not going to get the multiple that it does today as their growth rate slows and other competitors take market share. So they can choose to use that and invest in all sorts of VC projects and buy companies that become a less transactional model, or they can stay what they are and they're going to end up like AOL. I think, my view is a little bit tinged with some hope as well that they do end up like AOL and not end up like Facebook, because I'd like to see the cryptocurrency ecosystem be more distributed than, in one hand. But I really do believe that it's going to be hard for them to end up like Facebook.